GKFX Prime presents the Market Analysis Webinar.
Hello everybody, hope you're all doing well and having a good start to the week. This is our weekly webinar, and as normal we're going to cover the forex markets and commodities, indices and a bit of crypto. If there are any markets you'd like us to cover, please drop us a comment, and if you're enjoying the video, obviously please click a like button, that always helps. The general idea today is that we would look at some technical analysis for the euro dollar and the dollar yen and pound dollar and the Aussie dollar and gold and Bitcoin and WTI crude oil and the S&P 500. So without further ado, let's have a look at the euro. Now this is interesting. This is the 4-hour chart, and we had this trend line in place last week. We were looking at the bounce off the trend line. We pulled back again, but interestingly we also had this rising trend line connecting these first two lows, but you can see later on the trend line was formed based on the lows, and then we had two false breaks where the wicks of the candles dropped below the trend line, and then on this latter test there was only just a smaller wick, so it looked like it was almost gaining strength. And then all the way over here we actually had a confluence of support by the one declining trend line and the one rising trend line. So strong support coming in there. We did get a dip below the RSI rising trend line, which is a slight bearish risk, and you can see that there is some pretty thick resistance. If I just come along here and if I just draw a rectangle to give you an idea about the zone, you can see that through this kind of area, these previous peaks tried to break above, tanked back down, found support at these big trend lines, and then again on this rally we're tipping over again. So clearly some big overhead resistance. That's 113.50 that the euro is trying to break through. So far on 5 tests we've failed. So that really is the critical level that we need to get to. A move beyond 113.50 in terms of breakout trades, that would be I think positive for the euro. On the downside, I think there's no clear trend in place. We've broken this triangle to the upside, but the upside hasn't really fully formed yet. If we do get a break below this rising trend line here, then I think that 112.50 is the nearest round number to that. I think then we have to flip a little bit more bearish, but we don't go and turn completely negative on the euro until we feel like a top has been put in throughout this whole consolidation area, and the break of that top would come with a move below 112. So for the bears out there, we have had a break of this rising trend line. We've been stalling heavily at 113.50, haven't been able to break it. That's the bearish case. The bullish case, we've broken to the top side of this triangle, found good strong support at 112.50 for the second time in fact, and so we could be on the cusp of a big push higher. And you'll see when I cover it in just a moment that there is some support. If you believe in the correlation between the euro and the Aussie dollar and the S&P 500, there's some reasons to think those two other markets are pushing higher, and so then that might mean that the euro is pushing higher too. Let's have a look at the pound. This is our daily chart, so we're starting on the daily this time, not the 4-hour. And this is how I am viewing the situation. We had a big rally, we're in a range, we had a false break lower, false break higher, we've held the support, and now we're at the resistance again. So based on previous occasions, somewhere from this horizontal line here, which comes in at around 126.50, and then you say as high as 128, previous occasions have seen selling. So the higher probability trade at the moment is coming down from that resistance, but clearly at some point in time we need to break this this trading range, and it could be to the upside obviously. Now let's just drop down to the 4-hour chart and see what we're looking at. Here you can see but the beginnings of a double, if not triple top coming in at this 126.50. Clearly from a short-term trading basis, we've already had two tests from there and we're already quite substantially lower, so we're slightly missing the boat. Really you wanted to enter at 126.50 on the dot. But if we get a kind of completed short-term head and shoulders pattern here, you can use the short-term pattern as a confirmation of the fact that 126.50 is holding, and it would be reasonable to expect a move back down to the bottom of the trading range again. You can see that we've been in quite a decent steady bullish progression. So we had with the false break, we came down to the old support as we mentioned on the daily chart, but we rallied up to the old high. We consolidated there, we break to the top side, we pull back to the old high. Obviously, you know, these things aren't perfect, but more or less we pull back to the old high, rallied up, pull back to the old high again. This time we've rallied up, we've not taken out that high, we're turning lower. So a slight shift here, but you know, this has happened before. We're in the consolidation phase, and then so consolidating here potentially before the break. And what I'm saying is this break might have more significance than these that was within the broader trading range. This would suggest that we're again attempting the breakout, which last time was a fake out, but this time assuming that this selling has been absorbed here, then that would have a better chance of pushing to the top side. So signs of a top, but early days yet. For the moment, let's assume that the trend maintains. So maybe we look to the bottom of the trading range here around 125.70 as lower risk. I don't mean lower risk, but I mean higher risk to reward ratio trades for moves back to the top of the trading range and beyond. If you think we're coming towards that bullish breakout, you don't have to wait for price to be up here. You can take a lower risk and higher potential reward trade down here. But of course, if it drops, you can still make a losing trade, but it's just you don't need to buy at the top so much, so you're pulling on a downtrend. So you're just necessarily getting a better price. So I think that we're inside the range. We're potentially topping out at the top of the range, for setting up a move lower. But if these previous lows hold and we stay in a trading range, that would set us up for the top side break. So be prepared for either scenario. Keep an open mind. It's always the best way to approach the trading. Okay, this is our dollar yen daily chart, and interesting that the 50% fib that we mentioned last week has held up pretty well. It's worked nicely as a trade, and we've come back down to this previous peak here, not quite reached it, but 106.50 is where this line comes in. We've rebounded a bit from there. Dollar yen still a bit of a mess, but I think one thing to kind of think about is that this was quite a dramatic move lower. Now we did hold on to the previous low, which is encouraging, but still that was quite a significant low. So we've rebounded off it. We've pulled back 50% of this big sharp drop. So if we're going to get another one of these big sharp drops, we could have already started it. We're kind of stuttering, and it could accelerate as we approach these old lows, and buyers get a bit more nervous that we haven't managed to progress beyond that 50% retracement. So I think if I was going to pick a spot here, it would be that we get another leg lower, a big drop, retracement, big drop. What would negate that is a push beyond the 50% retracement. Then I would think that this selling's all been absorbed, and we're making a broader price range of more like this rather than this. Over to the Aussie dollar. Interestingly, the RBNZ had a meeting this week, and oftentimes the Aussie and the Kiwi dollar move in sync. Australia seeing a lot of much higher virus cases, and it was considered a kind of haven in terms of the pandemic, but not so much at the moment based on Melbourne. But nonetheless, the Aussie is right up at its near 3-4 month highs. right near the 70 level. Let's remind ourselves the situation. Oh, I'm even underplaying it because this was the peak that was made in at the end of the year, right at the start of the year, was up at zero point 0.7. So we made that huge collapse down to 55, and we've rebounded all the way back. So that's really huge. And bigger picture, when you're talking about V-shaped recoveries, that is it. So massive drop, massive recovery, and you can understand why things are stuttering out here. But based on the sheer, of course we could just be in a new volatile range and we're about to drop down again. But it sort of feels more like the Aussie dollar's been trending down for quite a while, quite a few years. And maybe this is, look at this previous low down here. We don't always go out to the monthly charts, but it's good to get perspective sometimes. We came down to this level, V-shaped through it, and closed the first month above, and the subsequent months have rallied up. So this could be a game-changing situation for the Aussie, and that would fit with the narrative that the US dollar is set for a period of weakness because of all the actions from the Federal Reserve. So there we have it. But I had mentioned at the in terms of the euro that there is some signs that the Aussie is breaking to the top side, and this is a similar situation in the S&P 500. You'll see it's gone right to the edge of this triangle pattern that I put, the kind of ascending triangle, and it's pushing on the tops, and it's condensing in terms of volatility. So we're going to get a breakout one way or the other. One possibility is that we get a false break one way, because generally the rule is that you want to see the breakout from a triangle pattern around 2/3 of the way through the pattern. Now we're pretty much 100% through the pattern. We're almost coming up to the apex. So when that happens, study of these triangle patterns suggests that we're more likely to see an initial false break than the break in the right direction. So just keep that in mind. If we do start getting a surge up through 0.7, actually, given that we're closer to the apex of the triangle, we could be about to turn lower. And vice versa, of course. So let's look at gold. Another example of where we've had a fairly decent looking progression in terms of the 4-hourly trend. So you can see we had a consolidation for a while here right through these peaks, but we got the breakout to the top side here, rallied up, pulled back to close to the old peak, but into those old lows, and obviously the round number of 1750, rallied up nicely from there. Didn't make it too much beyond that particular peak. Oh no, I've kind of jumped ahead of myself a little bit. Okay, so we rallied up, we pulled back to that high here, almost, we've got the day up, pulled back straight away. Then we rallied up again. Then we, in theory, would have pulled back to this high, but we went a bit further. We went and tested the low, but we rallied up from the low and we made new highs. Again, we pulled back to this interim low, and we highlighted last week these two strong signals that suggest a kind of bullish bias despite that big bearish candle. And actually it did turn out to be bullish, and so again, you can see that the previous peaks were taken out with a breakout, and here's where we find ourselves up just below those 9-year highs that were made yesterday. The trend is higher. I don't see any strong evidence that the trend is reversing yet, but it has been going for a while, so it certainly could reverse. There doesn't seem to have been much evidence of selling into the 1800 mark on this rally. It's a very steady rally. For the moment, it looks like we're going to keep pushing higher. My idea is that potentially we run out of steam heading into maybe 1850. But you can see on a daily chart, small evidence of a kind of big rally up, 2 correction day down, and then potentially the leg up again, which is a fairly reliable price pattern. So let's move over to the oil market, and again look at triangle patterns again. It's not just a love of triangle patterns, but actually just they keep reoccurring after this big rally since March. these risk-on assets quite well correlated. Worth noting, we've got an OPEC meeting on Wednesday, so what OPEC decide probably will determine the short-term direction. It seems like they're going to they're going to ease the production cuts that were made in April. Normally when you add supply into the market, that's bad for the price, but probably in this instance, the market's expecting that the cuts get eased as demand comes back following lockdowns, and so it would be almost a bad omen if OPEC were too scared to ease off the production. It would almost be like they've lost faith, and I think that could even be bearish for the market. So assuming they do ease the production cuts, probably with about 2 million barrels per day, then I think that could be the catalyst for a more solid breakout beyond the 40 level, which you can see more or less has been what's been capping the price here. Just been stalling out at 40, and we're looking for that, there's a rally up the pennant pattern, and then looking for a continuation of the pennant up higher. So this is Bitcoin. Started off with a daily chart, and again we're just stalling out at the 10,000 mark, and another triangle-ish looking pattern, more like a diamond. You could maybe, with the top bit's a diamond, this latter bit's a triangle. Declining trend line. A break through this RSI trend line could give us an early warning that we're about to get an upwards price breakout. Similar deal with the Aussie, where we've come right into the apex of the triangle, so it's possible we get a false break to the top side then lower, or false break to the bottom side then higher. That bottom side break would be good, because say we get a break through the triangle pattern, but if we come right into this support through here, where these series of lows have been working pretty good, around 8875, if we had a false breakthrough there, supported there, off there again, and rallied up, that would be a great trade setup in my opinion. But 10,000 is a big barrier, and it's been really taking us a long time to get through it. So there's clearly a possibility that we just capitulate and roll over, and this is the projection level that we've mentioned for the last few weeks. If we get that downside break, it's going to be somewhere in this vicinity, which, based on the slightly higher price from last week, comes in at pretty neatly around 7,700. Now let's look at the S&P 500. Bit of a crazy looking chart because of the Fibonacci, but the main point was that we had the drop at the beginning of June, again in another bit of a V shape rally straight up, ran into the 76.2% Fibonacci, and we stalled in there. We turned lower again, rallied off 3,000, came up, broke the descending trend line, rallied up, came back and tested it again. So we've had two tests of this declining trend line, and finally we've come up and broken through the resistance. So it all looks pretty positive to me. The final line in the sand, of course, is those June peaks, but it all looks like it's setting up for a break. In my opinion, it looks like a positive setup in markets. The trend is higher, the moving averages are aligned. If I can take this Fibonacci, we did retrace. This was the chance for the market to turn lower. This was another chance for the market to turn lower in that kind of golden area. It didn't, and so once we're past those fib levels, you basically are looking at more like a trend continuation than a drop and a retracement and another drop. Right, that's it for this week. Thank you very much for watching. Make sure to subscribe on the YouTube and social media channels where you're watching this, and see you at the same time next week.